Welcome to Al Stock Trades. In this video, we're going to be talking about the Netflix stock. I mean, let's just leave this paper here. This is the shareholders paper. Just look at the stock, guys. Look at this massive drop. This looks like the Universal Studios Jurassic Park ride that literally comes up here and drops like an 80 feet vertical fall here. Yeah, so that's really bad, all right? I feel bad for Bill Ackman. All right, so we got to talk about some things here, all right? Because we did initiate a price target on Netflix and one of our prices here. So we're going to go see what that is. Just first of all, there'll be a link down below. Make sure you get your 5 free stocks. Weeble's only offering 2, but now they usually offer 2. Now they're offering 5 free stocks. All you got to do is deposit at least a penny. So seriously, take advantage of this. You can get up to $9,600. So definitely do that. So what we can do is we're going to be searching just quick. What was our original price target for Netflix? So our original price target here for the Netflix stock was $5.50, but we gave a, let me make me smaller. We gave a bull, a base, and a bear case scenario, right? And by giving a bear, we're looking at $260. However, if you look at the stock price right now, it's basically past our bear case. And there is unfortunately merit to this, right? As something big just happened. That's why it's always important to keep track of your stocks every 3 months and allocate risks to this. Like, for example, if you wanted to invest into Netflix and you were waiting on the sidelines, you could have said, okay, well, I did the calculative price target on our intrinsic value calculator here for Netflix. And you look at the 260. Let me make me smaller here so I can more work room here. Then you could take a 20% margin of safety of 260, which is 52, and then you take 262 minus 52, you're looking at $210, which essentially was right around the margin of safety of the bear case, right? So that's when a lot of these quasi-semi-value investors came in and swooped up those shares. However, again, this is based off of our old calculation. Again, if we got some in our private Discord channel, which you can find in our All Stock Alerts here in allstocktrades.com, or you can visit our Patreon here. You can get into our private Discord channel. A lot of our members, a good chunk of them are actually value investors, right? This one right here. A lot of them are value investors, right? So, what they do is normally we do the price target calculation. They take a 20% margin of safety, and they said, hey, once Netflix hits 210, I'm going in. However, I'm making an updated video about this just for all y'all price targets here, because this is no longer the whole 550 waiting for it to go to its intrinsic value calculation. Unfortunately, that is not going to be the case based off of the slow subscriber growth numbers. Here we were anticipating some unfortunate, updated growth, but it looks like emerging markets, they're sharing passwords too. And, this looks like a Peloton thing, right? With the whole growth of the COVID boom, right? So what we're going to be doing now is we're going to be redoing this intrinsic value, and we're going to do it we're going to do a good calculation for y'all here, okay? So as you can see, just to give you, if you don't know the financials of Netflix, they've been doing really well. I mean, I don't have to tell you that, right? The net income extremely well. The only problem I have with Netflix is look at the free cash flow. Yes, this is not incorrect. They're free cash flow negative. Again, they're so focused on growth that again they're like, oh, we'll take care of that later. However, they started to anticipate this slowdown possibly around the 2020 days, which is why they put a little bit more into growth, and they realized that, we are most likely not able to get to that growth that we had originally. So now, because there's in 2020, a lot happened in 2020, okay? You got Disney Plus, HBO Max started kicking it with AT&T, so there was a lot of competition within the streaming platform, okay? Then you got YouTube, Google doubling down on YouTube, which you're watching right now. And as you can see here, a lot of hedge funds and a lot of seasoned investors, just leave alone Bill Ackman for a second, they've known that, hey, Netflix is geared for a slowdown. Now, I'm not saying it's worse than Disney Plus. They got Marvel, but how many shows can you make of those? There's so limited pool of actors. So it's definitely a challenging environment to value these types of stocks. But, I've been doing this for 10 years here, so this is quite it's just a simple, easy fix here. So as you can see, the best thing that Netflix can do right now is fix their free cash flow. They need to fix this, and they need to work on the market that they have, which means that they need to essentially say, hey, no more password sharing, and try to figure out some type of code that makes the account holder having to constantly approve these. Again, it could say, keep approving that trust this device, and maybe you can only have 2 to 3 trusted devices. Who knows? But again, it's a very difficult market to be in. So in this calculation, what we're going to be doing is we're going to be giving you guys, instead of giving you the net income here, because that's tainted, we're going to be doing the revenue year, quarter over quarter year, which was 9.83%, which essentially is from their 10% growth, which I read somewhere in their report. Oops. Yeah, our 10% revenue growth. So we're just going to be doing that. And I think that's an overestimate, but we're going to be looking at different discount rates, okay? So because of that, we're not going to be calculating the net income here because that's not reliable anymore. We need to know at this level, because Netflix, I wish I had my Wacom here. I'm trying to think. Yeah. I thought of an idea. So I can draw here. Okay. It's going to be a not good drawing, but it's going to be good. So the thing about Netflix, if, it's been growing really well. We're talking like extremely, extremely well, right? And the problem here that we have with Netflix is that every time we do an intrinsic value calculation, we like to take essentially the slope, right? We got to say, here's the slope here, and the slope is that. So again, m equals y2 minus y1 over x2 minus x1, right? You'll want to look at the slope here. And then you want to go ahead and take a look at the slope here, right? And as you can see, which slope is essentially bigger? Well, which type of growth do you want? You want it here or down there, right? Obviously, you want it here because if you draw a line, that's more than here. This slope 1 is more steeper than the second slope, right? So for quite some time, Netflix has been on a extremely just bullish run, and we're just waiting for it to kind of change direction and slope. Now, it could be a slowdown and they can fix it, and that's what it's been experiencing. But for now, Netflix has gotten to a point where could they have peaked in comparison? Are they going to go down like this? And this is the question that we have to ask ourselves. The problem is this is every 3 months, right? Every 3 months we get, every quarter, right? We have, this is Q1, this was Q4 of 2021, this is Q1 of 2022. Every time we have something like this, we need to do an intrinsic value calculation to go 10 years out from this direction to see what is the price of the stock in today's present value, okay? So this is very tough, right? This is a lot of work. So, but this is what it takes in order to essentially beat the market. Now, again, if you don't, for people that don't want to get their nose into this, and it's like, just invest in index funds. It's tough, right? Let's go ahead and quit this toothbrush here. Okay. All right. So now that we explained kind of the idea of what this is, and again, you can find this at the Mastering Stock Market course. Use Save 50. It's to get you $50 off here. It gives you my intrinsic value calculator. So now that we talked about this, now we're going to go ahead and do the new calculation. So we're going to have to estimate the free cash flow. Now, again, Netflix, it does, it's in a definitely different pickle, right? It's positive net income, but negative free cash flow. So we are going to have to estimate the free cash flow. Now, since it's a subscription service, we're going to do 15%, okay? And that's giving it some. I would do normally 10% for this company, right? But assuming that they can get their butts in line, we can give them a 15% in terms of the, allocation of what that estimated free cash flow is going to be. So we're going to do, assuming that they're going to be able to hit that 2021 mark, let's use the past 3 years of numbers from 2019, right? So we got 2156. This is for the revenue, right? 29.698. Actually, 24.996 and then 29.698. Okay, so you see this right there? Now we're going to estimate the free cash flow by just taking these numbers and multiplying them by 15. And that should give us an estimate. Now we can go lower, right? But I doubt that these people are going to drop their subscription unless Hulu, that'll be a different story if people start dropping, right? But from this, we got 0.023 minus the Ukraine war problem that they lost subscribers there too. 3749.4. So this is the average. It doesn't matter what year you put it in. It just takes the average here, okay? Remember I told you we're going really conservative here, guys. They can fix themselves and, they can grow. But I don't think next quarter they're going to grow. They're going to be the same story. So we're going to use 9.83. Okay? Oops. So we're just going to drop it into 9.83. And the number of outstanding shares here for Netflix is 455. Okay? 455. And if you look at the stock price, you can see the stock price hovering anywhere between $105 to $184 for the bull case. Now, usually for a stock like this, there's a lot of backing it with the revenue multiples. I would say, if you asked me this a while back ago, I would say good luck finding it at 184. But I would say if you want to do, if we're in a market recession and things get really, really bad, who knows? We might even see this bear case and even 20% margin of safety on the bear case. Again, those are for extreme investors. I would dollar cost average. I wouldn't wait until it hits below 100. But a good price for the value investors out there would be something of the sorts. 36, 30, we'll call it 38. Not that, 37. $147. So we'll say $150 would be an entry point for value investors, right? But as of right now, based off of these calculations, based off of what their growths are, they need to change their business model. It's very evident right now that Netflix, I'm going to make my face bigger, okay? This is attention. Netflix needs to change their business model because based off of these calculations, and this is me being, you can remove these two numbers here and assume that they're always going to get that number, 20, always going to make $29 billion. You could do that. But the most you'll get, maybe 220, I don't know, let's see. Yeah, $219 and give it a call it 44. $175 you get in. That's a nice price to get in, right? But you can see that's, I think, what the market's valuing it as right now. 220, because if you look at the Netflix stock price, yeah, it's around 220. That's what they're looking at right now. That's the calculation they're looking at, is around 220. So this might actually be a more accurate price representation, right? Getting in at 175 for the base if people want a margin of safety. But this is what it's worth right now. Based off of these calculations, this is what it's worth. Now, again, I'm a little bit more conservative, so we're going to go ahead and put the numbers here. Yeah. And I didn't even put the decimal points. It's okay. $184, it's like, that's the bull case. So that's obviously below the value of what it's trading at now. And that tells me one thing. If Netflix doesn't change their business model, like providing ads, putting ads like YouTube, then they're going to have a tough time. They're going to have a tough time. I mean, you could literally short Disney, short Netflix, short all the streaming services, and then go long Google, right? Go long Google and short the rest, right? Because Google's killing it, right? Google is like, is doing great, right? So, and this was to be predicted based off of the post-pandemic highlights, right? A lot of tech companies were definitely overvalued. I just thought that they'll be able to go into those emerging markets like Squid Game and be able to capitalize on that, but they honestly haven't done it. They don't have it. So, but we did leave a wiggle room here for 260 for the value investors out there that take a 20% margin of safety. That puts you in line to where the stock price is trading at right now, right? $210. So if you want to get in and wait for them to change their business model, I would definitely get in, right now. But personally for me, I'm going to wait. Again, I do these price targets, and if people are interested in them, go for it. If people, I'll let you know what I like. These are the ones I have high conviction in here, right? I think T-Doc's a good one. All the other ones here, semiconductors are great. But right now, when it comes to Netflix, it seems to me that they need to change their business model. They need to do kind of a Peloton thing. Their subscriber growth is not growing as needed. And in fact, here, I downgraded Peloton not too while ago. We'll just do this right on here. So yeah, we'll put it a hold. This is honestly a complete downgrade, right? So yeah, Netflix, complete downgrade. And we're downgrading it. My price target for Netflix, I would say, because it's a tech company, I would put it at $185 price target. $185. So that's my price right there. And it's definitely overvalued as of this point based off of their abysmal revenue growth. And, you could have calculated, it's really beautiful how this works. I'm personally not in the play here, but you could have calculated where as soon as the earnings were released, you could have done a quick intrinsic value calculation. And even, it was trading at those, around 300, you could have been like, that's way overvalued. I'm out, right? And you could have gone out from there. But Netflix needs to change their business model. They need to go into ads. They need to crack down on those things. The whole business needs to change now. Now it's all about refining what they have. Overall, that's pretty much all I have to say. Just don't forget your free stocks here. That's a must. They'll be linked down below. And if you want access to our Patreon, it'll be here. And if you want access to the intrinsic value calculator, it'll be here as well. Here's more information about it. Here's some testimonial videos. Here's the intrinsic value calculation and everything that we offer. It's currently half off plus an additional 50% off here when you type in the coupon. Save 50. Cuts it off for you like that. All in all, it's a pleasure. Yeah, let me know. Drop down what you guys think of the analysis. And I honestly can't wait to see what Bill Ackman's going to say. This is going to be I can't wait to see what he pulls out of this one. All right. See you guys.